Ground. Our guest host today, as mentioned, somebody very currency focused, Ashraf Laidi, a chief global strategist from Citi Index. Ashraf, hi.
Hello, Lisa.
How are you reading the markets? How are you reading the data? How are you reading the dollar?
It seems that the bond market, when we come to these days and you say, Ashraf, it's all about the foreign exchange market. Well, these days it's all about the bond market. And the central banks, when they have lost control of trying to contain the market, they have led to the guidance, using the semantics and using the conditionalities. I think the Bullard remarks, they seem to be on the dovish side. But it's interesting that you mentioned that the jobless claims fell to a 6-year low. I think this is telling the bond market that it's safe to expect that the Fed, they'll just have to scale down the purchases by 5 billion, by 10 billion. Not that it's going to make a difference, but it's going to have to show that Bernanke is going to have to scale down something that he just started before his way out. So this is for the sake of the Bernanke not appearing to be the master bubble maker. But I think they will have to do that. Here is the thing what people are not talking about very much. If they do not scale down the purchases, then the bond market may actually raise bond yields even faster, because they may think that even though the inflation numbers that you saw are a bit weak, that the inflation genie may come out of the bottle faster than they think. Or just when they are watching the CPI, we may see sort of inflationary cost from the job figures. So I think that they may have to do that, and I think the FX market, it had stopped selling the dollar when we reached to 134 against the euro, when we reached a 96 against the dollar yen. And I think that's what probably the FX market is trying to see.
I mean, just on inflation, I know a lot of viewers here in the past couple of weeks, they've been pointing out to me that the wage inflation data is still rising slower than what we're seeing the actual inflation data, and just how long can you continue to see kind of a wageless or wageless growth recovery happening? Well, I'm saying that wrong, but how long can you see recovery based on wages not increasing by as much as inflation?
Well, I think that probably will depend on the unit costs. I think in the case of the United States, we're seeing that basically in the purchases of for Japanese cars basically have come down because the strong dollar is able to contain the inflation low. But I think the central banks in this country and in the US have made clear that this is very much about jobs. And I think you cannot ignore the inflation, the unemployment rate falling from 9% to close to 7% or to 6%, and without the Fed having to do nothing. They have to do something. Whether September will lead to an announcement with an intention to scale down in December, or September FOMC will lead to the actual reduction, that remains to be seen. But they have to do something. And but we cannot ignore that the yields are at 3-year highs, and from the technicals aspect, the 10-year yield in the US has broken above a 6-year trend line resistance. It's a big resistance, and it has broken above it, and it was at 2.65, and now we are around 2.8. It's very hard to ignore that. Okay,
we'll come back and we'll touch on some of these points that you've just opened for us, Ashraf. Thank you for these initial comments. Get your email questions or comments, something to stem this. And you've got to wonder what happens once we start to see Fed tapering, whether it's going to stop some of the hot money flows into emerging markets, which also has had an impact on emerging market currencies.
If the tapering could have a negative or systemic impact on risk appetite, then that would make this story probably will add another reason for people to jump and to actually sell the currency, the rupiah, as a reaction to the authorities doing something that they don't want to happen, which is basically exchange controls. When a country does resort to that, it's a sign of probably the desperate act. And even though there is a new central banker coming from the United States, or we used to be with the World Bank, and he is really overseeing this, I think that really shows a matter of desperation. The question is, if the tapering leads to more of a sort of a risk aversion or a risk trade and more cracks in the bricks then probably the rupiah might be one of the currencies to further take down if the policy landscape is not seen as conducting the country to improve.
There's some interesting research, incidentally, if you want to find it yourselves out there. Morgan Stanley to Ashraf, which G10 currencies would suffer the worst hit when the Fed tapering starts?
Probably the Swiss franc. It's a central bank that is doing all it can to try to prevent the currency from appreciating and doing all it can to keep the yields low. And I think I could go further. For those people who are not so excited in going long the euro against the dollar, they may actually look at the euro against the Swiss. And I think what is now a 1.24 rate, euro-Swiss, could probably go towards 1.30.
Comments on the pound, also very popular today. At Sanj Singh tweets through and says, where is the pound dollar going next? Where's cable going? And also at Dean KCPFC says, has anybody got a comment on the pound against the rupiah reaching its highest level in some 20 years?
If the pound is expected to appreciate further against the Swiss franc, then I think it's going to expect it to appreciate against the rupiah too. For the reasons that we mentioned earlier. But against the dollar, I think we could be looking at a ceiling and a target at around 1.568, 1.57. Again, the technical people are looking at a 55-day moving average, 100, 200. All of those guys are hanging around 1.57. There is nothing that is going to prevent it from going down. We'll have to revisit that before we correct towards 153, but we're not going below 150 for a while now.
And do you think maybe the UK, there's a danger or a chance that we could be looking at rates heading higher given the data being better than what Carney might be anticipating?
No, maybe a reduction maybe in the asset purchases, but we're a long way away. And because all this talk about increasing rates is so far off, there's more of an emphasis on a 2-year yield spread than a 10-year yield spread. So let's not waste our time with the impact when the Fed is going to raise rates and when the UK is going to raise rates.
Excellent.
Please, let's not do that.
We'll get to some more of your questions in a couple of moments here within the live. Well, Ashraf, thank you very much for your time today. Thanks a lot for your commentary as well. Hope that we got some of the questions answered. Laidi writing in today on currencies. Ashraf Laidi, Chief Global Strategist from Citi Index. That's it for Closing Bell. We'll